The rule of 100 is saying, okay, well, let's say I'm 45 years of age. You take your age minus 100 or 100 minus your age, and then that's going to tell you how much money that you have in stocks versus bonds. So at age 65 minus 100, 65. So 35% of your overall allocation should be subject to risk and the other should be safe money. Don't do this. If someone is pitching you this, this is such elementary BS. You want to make sure that you have a portfolio that's very specific to your cash flow needs. Your age has some portion of the overall equation, but Al and I, we have clients that are in their 80s and 90s where 100% of their assets are going to grandchildren. Right, so they have if we did the rule of 100 at 80, their grandchildren's portfolio would be 100% 80% bonds. It just doesn't make sense.
Yeah, you have to be a little smarter than this rule of thumb. And in fact, at one point they said, well, since this doesn't really work anymore, let's take 120 minus your age. That still doesn't work. It's your own situation. Figure out what your goals are, what rate of return that you need based upon your goals, what you're trying to accomplish, and then you work backwards to try to figure out what investments are going to make sense for you to generate that rate of return. And generally, we recommend you have the safest portfolio possible to earn that rate of return. Why take more risk than you need to take? So, Joe, I think there's a few investment tenets that maybe we might suggest here.
But here, once you start getting to your investment strategy and philosophy, it's really what determine your exposure to risk. What target rate of return do you truly need to generate on the overall assets? Be globally diversified, right? You want to make sure that you have assets across the globe. And then just try to manage what you can. Low-cost funds. If I'm looking at, I'm spending 2% in my overall investment strategy, well, that's 2% that could be going into your pocket. So make sure that you manage your risk appropriately, looking at tax exposure. And then finally, it's just changing and adjusting this over time.
The stock market goes up, it goes down, it trends up over the long term. But people have a tendency to change their investment strategy based upon the economy. And that's exactly the opposite. You want to keep your investment strategy according to your plan. Change it when there's a change in your plan. Like, for example, you want to retire earlier. Maybe it means you'll change it at that point, but not because the economy is good or bad.